Welcome to The Explainer. Today, we're jumping right into the Q2 earnings call for Anthony Waste Handling. We're going to go behind the numbers and see how a really solid quarter is actually setting them up for a huge, decades-long pivot into energy.
You know, an earnings call is so much more than just a report card. It's really a roadmap for the future. So what we're going to do is decode their strategy, figure out exactly what's got investors worried, and try to piece together what this all means for where the company is headed.
So here's the game plan. First, we'll hit the financial results, then we'll look at the huge growth engine they're building. After that, it's all about the tough questions investors are asking, the risks involved, and we'll wrap it all up with the big picture, the long-term view. Okay, let's dive right into the numbers. Management kicked things off by talking about a strong and consistent performance for the quarter. You always hear that, right? So let's see if the actual data agrees. So the big headline number is this one, a 16% jump in operating revenue compared to last year. And according to management, that's coming from a mix of things, higher fees and just getting more efficient at what they do. And it's not just about revenue. Look at the profitability. Their core profit, or EBITDA, grew by a really healthy 18%. That puts their margin at a solid 22%, which is super important, right? It shows they're not just getting bigger, they're getting bigger profitably. And this chart here really breaks down where the money's coming from. Yeah, their main gig, collection and transport, is the biggest piece of the pie. But look at that processing segment. It's also growing by double digits. That's a great sign that their whole integrated system is really clicking. Okay, so the current business is humming along nicely. But the big question is, where does the next big push for growth come from? Well, management couldn't have been clearer about this one. Their future is all about turning waste into energy. And then management just dropped this massive number on the call. They've landed 2 huge new waste-to-energy projects. And get this isn't just some one-time deal. That 3,200 crores, that's revenue they expect to see coming in over the next 20 years.
But this is way bigger than just one large contract. It's a total strategic shift for them. Think about it. Instead of just dealing with cities, they're now selling power to state electricity boards. That means they're less reliant on one type of customer, and it gives them these incredibly steady, predictable cash flows for years to come. It's a huge move to make the whole business safer.
All right, let's get to my favorite part, the Q&A. This is where you really get to the good stuff. And a couple of themes just kept popping up over and over again, which tells you exactly what investors are focused on right now.
So the first big issue that came up was receivables. That's just a fancy way of saying the money that people owe them. And the analysts were pretty blunt about it, asking, hey, why is this number going up so much?
And here's the actual question from an analyst. You can just hear the concern, right? This isn't some softball question. It's a direct shot, really getting at a major worry for investors, which is all about cash flow.
So how did management handle it? Well, they had a two-part answer. First, they admitted it. Yeah, 114 days to get paid is a long time. But then they pointed back to that big strategic shift we talked about, moving to clients who pay more reliably. And they said they expect things to get better in the second half of the year.
The other thing analysts kept hammering on was returns. Basically, metrics that show how good a company is at turning its investments into actual profit. Well, those have been slipping a bit.
And management's answer here was pretty interesting. They said it's all about timing. It's like building a house, right? You spend a ton of money up front on construction. That's the capital investment. So for a while, it looks like you're just spending. But once the house is built, it'll generate value for decades. That's what they're saying is happening here.
So putting aside those 2 big questions, what was the general tone of the call? What was the vibe from the executives? And did any other, potential red flags pop up?
This quote, I think, really sums up their whole style. They come right out and say, yeah, we could have done better. They blame the weather, which, happens. But the key is how they frame it as a temporary hiccup, not some deep underlying problem with the business itself. So if I had to sum up their tone, I'd say it was confident but grounded. They weren't afraid to admit the short-term bumps in the road, and they kept steering the conversation back to the long-term plan. There were a few spots where they were a little vague, like on these new recycling credits, but it didn't feel like they were dodging the question. It felt more like they were just being cautious, not wanting to promise something they couldn't deliver.
And the call definitely highlighted a few other things for investors to watch. First, that working capital issue is still there. Second, these new projects are going to require a lot of money, which will keep putting pressure on the returns for a while. And finally, they're dipping their toes into new stuff like vehicle scrapping, which could be great, but it's totally new territory for them, so there's a lot of risk there.
All right, let's zoom out and put all the pieces together. We've looked at the numbers, the strategy, the big worries. So what's the bottom line? What should a long-term investor really be thinking about here?
It really comes down to this classic battle between two stories. On one hand, you've got the bull case, a really compelling growth story. They've got a proven track record and these absolutely massive new projects in the pipeline. But then there's the other side, the bear case. It's all about the risk. Can they actually pull this off? They need a ton of cash, it's hurting their returns right now, and those new businesses are still a big unknown. And so this is really the one big question that hangs over everything from this call. The strategy? It's crystal clear. The potential for growth? It's huge. But the journey to get there is going to be incredibly expensive and they can't afford any major screw-ups. So the real puzzle for any investor is this. Does the company have the financial muscle, the horsepower, to actually fuel this engine and see this grand plan all the way through to the end?